Hi, I'm Michael. I'm the managing partner at Greenbush Financial Group. When we're putting together financial plans for clients, eventually when we get to the insurance section of the plan, the natural question comes up, how much life insurance should I have on myself, on my spouse? I don't want to have too much. I don't want to have too little. So what's the right amount? And really, as financial planners, what we find is there's really 8 things that factor in to that calculation to kind of reach that right amount for you. And we're going to go over each one of those today. And also on the end, we're going to talk really quickly about, the difference between term insurance and whole life to meet that life insurance need. The first element is debt. So we really want our clients to total up all the debt they have from mortgages, credit cards, HELOCs, student loans, like everything. Because the idea is if something happened to one of the two spouses, without those life insurance proceeds, we would essentially want to wipe out all of the debt that's outstanding. So it really minimizes the expenses going forward for the surviving spouse and the family, so they have room to maneuver financially. Number 2 is the income level between the two spouses. So it's not uncommon, obviously, for one spouse to be earning more than the other spouse. And that factors in to that insurance calculation because we're really trying to replace the income if one of the spouses were to pass away. So if we have spouse A making $200,000 per year and the other spouse is making $40,000 per year, and the goal of the insurance is at least provide 5 years worth of income replacement, the 200,000 times 5, that's $1 million right there just to replace their income for 5 years, versus the other spouse that's only making 40,000 per year, times that by 5 years, that's really 200,000. So that factor of the calculation's big, and we unfortunately see married couples make the mistake where they just kind of blindly say, oh, yep, we've each got $500,000 policies. And it's like, well, that's great, but it would have been a lot better if you kind of did this analysis and swayed more the insurance to the higher income earner, because that's really the protection we needed. And if you looked at the premiums between the two policies, you might have been in the same place. Future college expenses is number 3. So if it's part of your plan that you have children and you expect them to eventually go to college and you want to provide them some financial support for a year, 2 years, or maybe all 4 years in college, that's a big future expense that has to come into this insurance discussion, because if something were to happen to you today and your spouse has that big expense sitting out there in the future, that should go into that insurance calculation. So if, let's say I have 3 kids and my goal is to provide them with the first 4 years to a state school, let's say the state school is $25,000 per year, that's $100,000 per child times 3, so that's $300,000 that I have to factor into my insurance coverage for that future expense down the road. Number 4 is, what are your household expenses? Now this varies a lot from household to household. So we could be sitting in front of one couple that makes $300,000, and if one of the spouses passes away, they might still need $250,000 of equivalent income to meet their annual expenses. Vice versa, we could be sitting in front of a second couple that makes $300,000, and if one of those spouses passed away, they would only need $150,000 to meet their needs each year going forward. It really varies from person to person, household to household. So we usually go through that kind of exercise saying, here are our current expenses. If something happened to one of the spouses, this is how much the expenses would anticipated to drop by. And then that's what we can factor into that kind of future earnings of the insurance calculation. Number 5 is your level of outside savings. And what I mean by this is the amount of wealth that you've accumulated that you have access to, that if something happened to one of the two spouses, that you could use that to supplement your income. So here's an example. So let's say a business owner sold their business a few years ago and they've got $2 million sitting in the bank or in investment accounts. Based on their needs, they might essentially be self-insured, meaning if something happens to that business owner, that essentially there's enough within that $2 million to support their family financially for the rest of their lives. They don't really need insurance. They're self-insured. And there's also that kind of halfway point where if you've accumulated some, maybe you need $1 million, but you've already got $500,000 sitting over in these accounts. Now you only need $500,000 worth of insurance coverage. So you really got to factor in those outside assets. But it's not just level of assets, it's also the access to assets. Because if we've got, let's say, a couple that's under 40 that has 2 kids, let's say they have $500,000, but it's all in 401k plans. If something happens to one of those spouses, Yeah, the spouse may have access to the spouse's retirement plan that passed away, but when they take money out of that, they're going to have to pay income tax on that full amount. So if the spouse that passed away had a $300,000 retirement account, after tax, that might only really be $200,000. So you got to make sure you have enough outside savings, and then you'll have easy access to the money. Number 6 is retirement savings. So when we're doing the plans and we're actually on the retirement planning side now, usually the clients are saying, yep, I want to retire by age 65. But if both spouses are covered by, let's say, an employer-sponsored retirement plan, and the plan has built into it that they're each contributing $15,000 per year all the way up to retirement, if one of the spouses unexpectedly passes away, now we only have contributions going to the one account, not both, because we lost the income stream. The question is that enough for that surviving spouse to still retire at age 65, or do we need some additional insurance coverage to help that? The other thing I will mention they got to pay really close attention to is pensions. So if your spouse is covered by a pension, pensions work differently. Some pensions are worded that if the employee does not reach and turn on their pension, they, instead of getting this nice lifetime income stream with a survivor benefit for the spouse, they get kind of this smaller lump sum benefit. So sometimes people use life insurance to say, well, until we've actually turned on that pension, we've locked in that spousal benefit, we're going to need some more life insurance that if for some reason the spouse with a pension passes, that life insurance will replace the pension that we were expecting down the road. Number 7 are parents that have adult children with disabilities. So they have a special planning item because usually in these situations, the parents are providing usually some sort of financial support for their child for the remainder of their life. So they're not just planning for themselves, they're also saying if something happens to me, there has to be this pool of money that will be there to aid my child financially for the rest of their life. And in these situations, a lot of times these parents will get life insurance on themselves that if something happened to them, the insurance proceeds pay out to what's called a special needs trust. So it's a trust for the child, and what it does is it protects their government benefits. So if the child's receiving Social Security, disability, any type of government assistance program, they can keep getting those benefits even though this money has been set aside for them and can support them going forward. The last one, number 8, is really the estate plan of the client. So some clients will just have it in their estate plan that they want to make sure they leave $500,000 to their kids or in a trust for grandkids or for a charity. And that's something that can be worked into kind of a permanent insurance policy, knowing at some point in the future when the insured passes away, that money will definitely be there to pay out, and a lot of times it's tax-free to whoever is receiving it. So now that we've been through all this, I want to give you a real-life case study. So let's look at this example. So in this example, spouse 1 has income of $200,000 per year and is age 30. Spouse 2 has income of $50,000 per year and is age 31. They have 2 children, Susan age 4 and Rebecca age 2. For debt, they've got a mortgage at $250,000 and they still have student loans for $20,000. And their financial goal for college for the kids is to pay for the first 4 years at a state school, which let's just say is at $25,000 per year. So if we kind of total up their debt is $270,000. And the estimated future college expense for the girls, not including inflation, is $200,000 in total. So if we're looking at now the income replacement standpoint, and we want to replace at least 5 years worth of income for each spouse, if we're looking at the policy for spouse 1, that's $200,000 in annual income times 5 years, which gets us to $1 million. And the total debt and college costs together is $470,000. So that gets us to a total insurance coverage on spouse 1 for $1.5 million if you just round it up. So for spouse 2, they had the $50,000 in annual income times 5, so that's $250,000. Again, total debt and college costs, $470,000, which brings us to a total of about $750,000 rounded up for that spouse 2 for the insurance coverage. So after we've conducted the insurance analysis, the next question is, okay, how much does it cost to get this insurance coverage in place, and what type of insurance am I using? Because there's term insurance, there's universal, variable, there's whole life, and I can tell you from doing these plans, usually for, I would say, 90 to 95% of our clients, term insurance makes the most sense because it's the cheapest it meets the insurance need, and then we can use the additional cash that we would have spent on this more expensive whole life policy. What I'm going to show you now is a real life example of what a $1 million 30-year term insurance policy from William Penn would cost for an individual that's age 30, is a male, is a resident of New York, they're a non-smoker, and they're in a preferred health class. So as of July 2020, when we're doing this video, the monthly premium for that policy would only be $70.46 per month. As you can see, it's fairly cheap, where if you did that with a whole life insurance policy, it could be 5x more than that, because it has that cash accumulation feature, which you may or may not need or find benefit from. If you have any questions, of course, please feel free to reach out to us. If you are a resident of New York, we can assist you because we are an independent insurance broker in New York State, and we have access to a lot of the major carriers. So we can run you quotes, make sure you get into the right policy for you. Please feel free to call us at the number below. Thank you.